Welcome to Unleash Your Retirement with David Corin from RVA Wealth Management. Our podcast is all about providing anyone considering retirement with the confidence they need to pursue their dreams in this new phase of life. We cover a wide range of topics, from retirement planning to investing with purpose, all while making you laugh and keeping things lighthearted. With David's years of experience and guest industry leaders to help guide us, you'll walk away feeling informed, empowered, and ready to take on your future with confidence. So sit back, relax, and get ready to join us on this journey to a new life.
Hello, and welcome to Unleash Your Retirement with your host, David Corin. I'm Wendy McConnell. Hi, David.
Hello, Wendy. How are you?
I'm good. I see we have our friend Mike back once again.
Yes, Mike is back to join us again today, and probably the next session too, because investments are a big deal. It's actually a very complicated topic. I mean, Mike's background, he used to be on the stock exchange floor at the Boston Stock Exchange. He's worked for Scott and Stringfellow, for Davenport here locally as an equity desk trader. And as I mentioned earlier, we've been working together now for 8 years. So, and he picks the stocks. So he does the research. That's what he loves to do. He's not exactly real fond of being a public speaker like he's doing today, but he will do it. If I ask him and twist his arm, he will come in and join me. So he's here again today with us. How are you feeling, Mike?
I'm doing well. It's good to be with you, Wendy.
Oh, well, we're happy to have you here. Now, I have a question about the stock exchange. Is it exactly like I picture it from the movies where, you're all on the floor, you're writing down things on notes and throwing them and yelling and screaming? Please tell me that's how it is.
When I started over there, that's how it was to some degree. It was a lot of fun because there was a lot of chaos and it was paper back then. Unfortunately, now I hate to tell you, now it's gone all electronic. So it's not nearly as fun as it used to be.
So I have to watch the movies in order to get that experience.
Yeah, we had some real characters back then. It was a great education.
Okay. Well, welcome. We're glad to have you. And we look forward to you joining us in the future.
And so I think we continue our journey, by the way, on investments, personal finance on steroids program here that we're going through. So it's been a lot of fun. And we talked in the last session about the two types of investments. You can loan money or you can have ownership, which would be the stock market in particular. I think, one of the things that we're actually going to talk about the fixed side, the loaning side of the equation first, because believe it or not, the bond market dwarfs, and I mean dwarfs, the stock market. It's much, 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 much larger. That's why you hear all these references to an inverted yield curve and things like that. It all has to do with bonds. So the bond market has successfully predicted through the inversion of the yield curve all of our recessions historically. So we have been living, by the way, for some time in an inverted yield curve environment. I don't know if we'll get into all the complexities of what that means, but essentially the bottom line is the shorter dated bonds now pay higher interest than longer dated bonds, which is upside down. That's not how it should be. And it is actually one of the reasons that a lot of the banks have been having trouble because they hold a lot of long dated bonds and that value has dropped a whole lot. So that's caused a real liquidity issue for many of the banks. I know I went beyond, jump forward in a big way, but let's start by talking. We'll run through the different types of fixed or loan investments, and we'll start with some of the simplest, right, Mike?
Yes, as you mentioned on the last podcast, your first investment is typically your savings account at the bank where you get a low interest, but it's safe. You can pull the money out at any time. And then you go on to CDs at the bank where you agree to lock your money up for a certain amount of time, anywhere from 30 days to 10 years, where you can't pull that money out without a penalty until the term is up. But you get a fixed rate. It's become a pretty decent rate of return. And those are typically insured by FDIC insurance up to $250,000, which is important.
And then you jump from there to money market accounts. So these are some of the safest. And money market accounts are essentially, they're not insured, by the way, by the FDIC, but they're invested in short duration treasuries and really short investments of a highly secure type. That tends to be what you see the money markets investing in, and you can get a little bit better rate of return than the savings account. Typically at the bank, it's probably going to be similar to what your CD rates are going to be in the money market. But the difference is that the money market, you're not locking your money up. You can get that money out at any time, whereas the CD, you have to leave it. Otherwise, you lose some of the interest that you would have earned on it.
And money markets, the interest is variable too. It's currently paying a pretty attractive rate, but that rate does vary, unlike a CD.
Yeah. So if interest rates start to drop, the money market payments, what you receive from the money market is going to go down as interest rates go down. Of course, interest rates have been going up for some time now as the Fed has been fighting our inflationary situation that we've got. And so far, they've been successful at avoiding a recession. But generally speaking, when you're in a tightening cycle like we're seeing, that leads to a recession. So I keep saying that because I'm trying to prep people to be aware that all indicators are saying that at some point in the future, we are going to get a recession. Now, it may be relatively mild, but it could be bad. We just don't know at this point in time. But it does, based on what the bond markets and what the Fed is telling us and what history is showing us, that's sort of where we're headed right now, based on these numbers. However, the economy does not reflect that because we still have a tight job market at the moment. And usually you're not going to see or even have a recession declared until we've got a very soft job market where people can't find a job. Right now, companies can't find employees. It's the other way around. So, Mike, you want to talk a little bit about bonds further in terms of, people, a lot of people, the only way they've ever been exposed to bonds has been by, a mutual fund that they have in their 401k, but they don't really understand what is that buying inside of that? And so, what's the yield? What's the coupon? What's the maturity date? And what's the term of the bond? Many people don't understand exactly how those bonds work. And when you use a mutual fund, you're having professionals buy those bonds for you underneath, and they're doing all this manipulation and identifying the bonds, et cetera. But you are very susceptible to an interest rate movement when you have a bond fund. Whereas if you buy an individual bond, it's a different animal, and you can control sort of that risk a little bit. So we talk about bond ladders. We'll talk about that a little bit later when we talk risk mitigation. But bonds can be very attractive when you buy them individually, but you need to understand how they operate. So, Mike, you want to talk a little bit about, what's the face value? What is that kind of stuff, that the language that we talk about bonds? We're
going to start first with bonds, individual bonds, and we'll get to the bond mutual funds later. They have very different characteristics, but bond basically is an IOU sold by a government or a company in order to raise money. In return for you lending the money, you are promised a return of your principal, and you will get periodic interest payments. Typically, you'll be paid twice a year on that interest. So bonds, the primary job is to generate income for investors. There's a different way that they can promise to return your principal. They can either back it by collateral, like a factory. They'll put that up for line. But typically, it's just the promise, the full faith that the corporation will pay you back with nothing physically backing up, is how they typically issue these bonds. The face value, also referred to as par, is the amount of the bond is initially sold for and will return if you hold the bond to maturity. So you have to when is this bond going to mature? And then you'll have a pretty good indication how much you're going to get back at that maturity date. Unless you try to sell it in between, you're pretty much guaranteed for most of these bonds, you're going to get your principal back and collect your interest as you wait.
Yeah. Do bonds always sell at their face value, or do they sell at a discount or a premium sometimes, Mike?
They almost always sell at a discount or premium. When they're initially issued, large institutions and governments will buy them at their face value, but then they're traded every day on a market, and they'll be either slightly up or slightly down. So you'll have to watch for that. The interest rate could look attractive, but you'll have to factor in how much you actually paid for that bond to realize what you're actually going to get back.
So the the amount that they pay, so the interest rate on the bond or the coupon rate that they call could be different than the yield.
Yes. The coupon rate is the stated interest on the bond. Let's say 6% in this example, but the yield is when you factor in what you've paid for the bond versus the coupon rate, the yield can vary.
Okay. So if someone buys a bond at a premium, so let's say that's a $1,000 bond and they pay $1,010 for it or something like that. And they're going to get a 6% interest rate. So when at the end of the day, when the bond matures, they get 1,000 back, not the 10, because that was the premium that they paid. And so their net interest rate is something less than the 6. Is that how it works?
Yes. The yield will be less than the coupon rate because they had to pay more for the bond initially. So,
and by the same terms, if they buy it at a discount and then when it matures, they get the full value of it. So they pay $900 for a $1,000 bond, let's say. That's a really cheap discount. But at the end of the day, if they hold it to maturity, they get that back. Then that difference, that $100, increases their overall return on that bond. Is that right?
That's correct. Yes.
All righty. That's complicated.
Yeah, I would say so.
And those are bonds for you. But if you understand it, you can. What we like to do with bonds, Mike, you might want to talk a little bit about what a bond ladder is. I know we're going to cover it more later, but just for people's reference.
A bond ladder is when you buy a series of bonds with different maturity dates. So you may buy a bond that's going to mature in 3 years, 4 years, 5 years, 6 years. And you'll do that to protect yourself from interest rate risk. And then when the bond becomes mature, the first bond, you'll reinvest it back into the market. And that way you're not putting all your bets on one particular time period, because what happens is if you have a bond that's a 4% interest rate and the interest rates are moving up, your bond value is going to be lower because people can buy newer bonds with higher interest rates. So that's called interest rate risk. So you'd want to spread that risk out over various years, and that would be a bond ladder.
Yeah, when you talk about interest rate risk, so we just came out of 2022 where we had a tightening run by the Fed where they really increased rates very rapidly. And as a result of that, what happened to bonds value? So, the typical bond, people think, oh, you're pretty safe. You don't lose money in a bond. But if you had a 30-year treasury, let's say, last year, how much did that higher interest rate move impact those 30-year treasuries in terms of that underlying valuation that you sell it for?
It was a huge impact. It was the worst year for long dated bonds since the 70s. So depending on how far out you went, a long dated bond like a 30-year could have been off 25, 30%. It was a historically bad year. So a lot of people were surprised in their 401ks. They said, hey, I've got this bond fund. It's a nice, safe place for me to be invested. And they were hit just as hard as the stock market last year. So that's something to keep in mind, that these bonds do have interest rate risk, and it could be significant in years like last year.
So if you have bond funds and interest rates rise like they did last year, you could lose 10, 12, 15% or more, depending on the maturity date of that particular bond fund. So, if you had a junk bond fund, it lost a lot of money last year, which is, by the way, a junk bond would be something that's a riskier bond, plus it has a longer date. It's because they're trying to get a higher rate of return. Those are the ones that got killed the most last year, was those longer dated ones, because interest rates now on short dated bonds are higher than even some of these risky long dated bonds. So that's where we get that yield curve inversion happening out there in the marketplace. So these can be pretty scary bond funds. Now, if you owned an individual bond, though, as long as you don't sell it, you pretty much know what your yield is going to be. So even if that bond valuation, let's say you paid $1,000 for it, and that's the par value, it's paying a 6% interest. So your yield is going to be 6% if you hold it to maturity. But if you try to sell it right now in the open market, you could only get, say, $700 for it. Well, you're not going to want to sell it. But guess what? If you just hold on to it until the end of the duration, as you had planned when you originally bought it, you're going to get the $1,000 back. You avoid that interest rate risk. That's how you avoid interest rate risk with the bond ladder.
Yeah, we like to buy individual bonds for our clients. It's peace of mind for us knowing that we're going to get this principal back unless the company defaults, which fortunately is very rare where a company says we can't pay the money back. If you're buying highly rated corporate bonds, there's a high probability you'll get your money back, and you're not going to be really stressing out about these day-to-day movements that you might experience in a bond fund. So that's a powerful tool within an IRA when you can buy these individual bonds.
Right. And Mike just mentioned ratings. So bonds are rated. So there's different levels of bonds in terms of the risk profile. There's the Standard & Poor's and Moody's. They all have ratings that they give bonds. And the higher rated bonds, the AAAs, the A's, the AA's, even the BBs, are considered corporate grade. So the risk there is minimal that those companies, it's really about the company. The company might default or go out of business and not be able to pay those bonds. But when you get down into the C's and D's and things like that, now you're talking companies that are considered very iffy about whether or not they'll be able to survive and pay those things off. So in order for them to raise money, they're going to have to pay a much higher interest rate, generally speaking. Does that make sense? That's sort of that rating issue.
Yeah, it's more of a risk, so you get more on your return.
That's right. That's
if you get the return.
Right.
That's right.
If you get the return. Yeah, so again, bonds are not risk-free, but their risk is mitigated to a large extent because in most cases, these companies do honor their bonds. And we buy a lot of municipal bonds or government type bonds and treasuries. So then it's backed by those governments. So that's a little less risky when you really think about it and look at those numbers. So basically the shorter duration and the higher the rating of the company, you would expect a lower interest rate. If you, by the same turn, do a long dated bond and buy a very low rated company, you should see a much higher interest rate. However, that's not the case right now because we got an inverted yield curve. So what we're sort of seeing is the opposite. The shorter duration bonds tend to be much higher paying. Now, I don't know about, and that's even true of higher risk bonds. They're going to be, if the shorter dated ones are going to have the higher yields on them right now, which is unusual, by the way, in the marketplace. So, and bonds are sold in a secondary market, as we mentioned earlier. So there is a market, just like the stock market, so to speak. It's the bond market where things are traded and sold and bought and sold, which you can do as an individual investor, but it's not easy. I'll be honest, it's not the easiest thing to do, but highly recommended, especially in this environment where we can get some nice short duration bonds with very nice high rates on them right now. We're going to move from bonds now over to stocks and talk a little bit about those so that you can get some insight into stocks because there are a lot of, when we talk about all the different types of bonds, there's a lot of them out there, as I mentioned earlier. And they are all about loaning money and paying an interest with lower risk, if you will, for volatility. Now, you can get that if interest rates rise rapidly. You can see volatility in bonds, but in generally speaking, they're safer from a fluctuation standpoint, at least, than the stock market. So let's talk about owning an investment, which for many people, their first investment they own is their home. Okay, that's a great example of owning an investment. So everybody can identify, I bought the house, I hope it appreciates over time. Well, if you own a business, it's the same type of thing. You're wanting your business value to appreciate over time. Well, if you own stock in a business, it's the same thing. You are owning part of that business with the hope that the value will appreciate over time. And that's really what we're looking at when we talk about stocks. So, Mike, how do stocks really work a little differently than bonds, and what kind of are we talking about in terms of markets and so forth there?
Stocks, if things go poorly for stocks, the corporations have no guarantee you get your principal back. They don't promise anything like they would on a bond. They're going to do their best to pay the bond holders back first, and the stockholders in a really bad situation are not going to get their principal back. So that's the first thing. stocks trade on the exchange every day. They're based on supply and demand. The price will fluctuate. One thing that's important to think about with stocks, though, is why are you buying them? We have dividend stocks, which are attractive to a lot of retirees, where they're paying pretty attractive dividends, where they could be close to what you could get on a bond interest, with the chance of also getting price appreciation down the road. Or are you trying to buy stocks with more growth characteristics, like a lot of these great technology names? They're not going to pay you a dividend, but they're reinvesting back into the business, and they have a focus on long-term growth. So you have to figure out what your target is here for your stock allocation.
Yeah, and dividend stocks can appreciate, but they don't tend. That's not their goal necessarily as a company. They really want to provide and make sure they cover their dividend for their investors. But there is always the possibility that they do appreciate very nicely. In fact, many of the dividend stocks out there right now are considered value stocks because they're companies that make stuff. They have a set sort of real clear P&L statement. You sort of know where they're going. They can cover their dividend. They're going to make money no matter what in terms of the market. We're talking food companies, pharmaceuticals. In some cases, we're talking energy companies. So, across the board, utilities, all of these companies pay nice dividends. And they're sort of considered as we talk about them, as value stocks because they're sort of steady eddies, if you will. But they can suddenly appreciate. And right now in the market, they're more attractively priced than the growth stocks because the growth stocks have appreciated so much. These value stocks look more attractive. And right now the market's not, I don't know, how do I say this tactfully? The market is fairly priced right now. And right now, growth stocks are a little overpriced, if you will, whereas value stocks relative to the market are a little more fairly priced. Maybe even you might even have the ability to buy one that's going to give you a little bit better return than a growth stock would right now. Not necessarily, but it could in this environment because there's more upside there.
Yeah, one key point, I think the difference with stocks and bonds is there's going to be a little more risk in the short term with stocks, but they typically offer the opportunity for more long-term growth than bonds, and they offer a chance to keep up or beat inflation over the long term, whereas bonds are probably not going to do that for you.
Right. And one thing that Mike mentioned earlier too about the stock, because it is riskier, because if a company does get into trouble and go out of business, they're going to have some infrastructure and things that they could sell off. Well, there's a sort of a pecking order, if you will, of who gets money. And the one at the bottom of the pecking order, if there's any money left, are the stockholders. Okay. So they're the SOL ones. The bondholders are further up. Preferred stockholders are further up. The tax man and the employees are further up. They have to do all those things first before anything goes out to the stockholders of whatever they've got left, if they have to liquidate and sell off. So that's another reason that stocks are considered a little riskier.
That's a good point. And you'll want to be careful when you're selecting your stocks. If you want to do this yourself and you're concerned about a bad situation like that, you typically want to focus more on the larger names, what they call large cap companies of a lot of household names, less likely of going out of business than one of these smaller companies that doesn't make it.
And, stocks, there's no insurance, no protection with the stocks. And they are bought and traded on the U.S. stock exchanges. So the New York Stock Exchange, the NASDAQ, there's several of these exchanges that are very well known. And those are really open markets, and it's all about supply and demand. So stocks can really fluctuate quite a bit in that open marketplace. And it's not all when people say it's real efficient. Well, it's not always that efficient. Things can move the market unexpectedly. Recently, there was a video that came out that with an AI showing fire near the White House in D.C. Everybody thought it was real, and the stock market went down. Well, it wasn't real. Stock market shouldn't have gone down, but that just shows you how sensitive the market can be, and how sometimes things that are, really not a big deal do impact the market. So it's not always that efficient. What I was trying to point out.
People
Well,
get very scared about the thought of potentially losing money.
Oh yeah,
For
and I
sure.
don't blame them. I mean, during the crisis in 07, 08, the stock market went down. The S&P went down 53% top to bottom. 53%. I mean, imagine losing half of your investment if you were all in the S&P, at least on paper. Now, by 2013, 2014, you've got most of it all back. But again, that's what I talk about. There's if you're willing, you got to be able to stick with it for 5 years at a minimum, and have that mindset about the piece of your portfolio you put into the stock market or the growth side of your portfolio.
And that's kind of like the different buckets theory. Like you've got this bucket for your income, you've got this bucket for investments and growth.
Absolutely. Absolutely. You need to understand how much you need to have in each bucket for your situation. And everybody's situation is different. Okay. We can have categories for different folks, but really everybody is sort of unique. So you have to really get a handle on what that individual can handle in terms of their risk tolerance as well as their risk capacity, because we have to dial that number in, because we don't want to underperform the markets and their expectations so much that they're disappointed. But by the same token, we don't want to be overly invested. So if the market comes down, they freak out. We don't want that to happen. So we have to find that balance, and the client has to be real understanding of that in terms of their investments in the stock market, because they are going to go up and down. Let's face it.
Yeah, I like to think of yourself, Wendy, as a long-term owner in these businesses. They could have a bad quarter report for their earnings. The market generally can move down. The stocks can go down. But if you have a belief long-term in the health of this business, you should be willing to possibly buy more if the stock price goes lower. You have that much conviction in the name.
I like it.
And, just like bonds, there are a lot of different stock categories. And I do want to differentiate between preferred stocks and common stock real quickly so that people understand. In our world, so the preferred stocks are also issued by companies. They're not common stocks. You don't have voting rights with preferred stocks, but they don't tend to move very much like the market. They are actually very much like a long-dated bond. And that's how they behave in terms of their pricing. So last year, they did drop considerably as interest rates rose, because these preferred stocks, it's all about the interest rate that you earn on those on the underlying investments. Long dated by these companies, and they're very attractive in terms of their yield. Their yield does tend to be quite high, but they can go down if interest rates go up. So you have to be aware of that. But in the pecking order, they're just above common stocks. So you might get your money back, a little bit better chance of getting your money back with a preferred stock than a common stock. And most of the time when we talk preferred stocks, the vast majority of companies that issue preferred stocks, for some reason, there are all kinds of companies that issue preferred stock, but the primary category are banks, financial institutions. They tend to be the ones that go to the preferred stock right for a variety of reasons. A lot of it has to do with tax scenarios and situations. And the other nice thing about preferred stocks is that there are some tax advantages to investing in preferred stocks, as opposed to like a corporate bond, for instance.
Yeah, and most investors are going to own these common stocks versus the preferred stocks, but it is important to understand the difference.
And you can buy preferred stocks directly one-on-one, or you can buy them in ETFs or funds, which we haven't gotten into a whole lot. Mike, you want to talk a little bit about company size when we, because that, and I want to go off on penny stocks in a minute so that people understand what can happen in that environment.
I mentioned before these larger companies, and that's most stocks are individual investors are more familiar with these large companies that have a market cap of $10 billion or more. So when I say market cap, I'm looking at the price of the stock times the amount of shares that are issued. That's how you come up with the market cap. So these large cap stocks are 10 billion or greater. A lot of household names that you're familiar with. They're more likely to pay dividends than smaller companies, but they may also offer some growth potential as well. And then we have the mid-sized companies, which will be between a market cap of 5 billion to 10 billion. A lot of these companies eventually do become large household names as well. And then you've got the smaller cap names that are worth 2 billion or less. They might be less stable during a recession. If things go really well, though, they have a chance for a lot of price appreciation. But more of them, there will be more that won't make it than large cap companies. So it's important to know the size of the company and get that mix right. And that has a lot to do with your risk tolerance.
Yeah. So the large cap, if you think about the S&P 500, that's an index that's out there. Those are all large cap companies in that index. There's the Russell 3000 that tends to include all the small cap stocks. So if you're thinking about indexes and you're sort of following these things, those are some of the differences in what they do track companies by size and their indexes out there. I do want to mention super small caps, which we call penny stocks, which are stocks whose value per share is less than $5 a share. There's a lot of bad things that can happen out there with penny stocks. So a lot of people can do really well. You know, if you're fortunate enough to own a penny stock and it really takes off, let's say a lot of penny stocks fall into the biotech area. They're really small companies just getting up and running, but they could come up with a drug that or some breakthrough that could be massive and their stock could shoot up in value and they get bought up usually by a larger pharmaceutical then. So there's big upside. But by the same token, those are the same companies that will go out and can go out of business. The problem in that category, though, is that a lot of folks will take advantage of this and try to pump up a stock for their own benefit by getting people to buy it, thinking it's going to go up. And then once they get enough people to buy it and they blow the stock up and say it's trading at 30 cents and you get a whole bunch of people to buy it and it goes up to 40 cents. Well, if you bought a whole bunch of it at 30 cents and waited for it to get to 40 and then you sold it and you knew that was going to happen, you knew that it was going to go up because you paid the money to push the stock, pump the stock value up. It's illegal, by the way, but it does still happen. But a lot of people fall for it because they think, oh, yeah, I read this article. It says all this good thing about this wonderful stock's going to take off. And hey, that's all just hype that's designed to pump the value of the stock up. Somebody's playing a game with you, so watch out. I just tell people all the time, be extremely careful and really don't buy them. I mean, that's the bottom line. It's just you're going to get, I mean, you may hit a home run, but the odds are against you. Let's just put it that way.
It's like buying a lottery ticket when it's over $1 billion.
Yeah, that's exactly right. That's exactly right.
So if I think that I want to have a professional pick and monitor the investments for me, what does that mean at this point?
So if you want a professional to pick and monitor, that's what we do on the investment side. So as advisors, we strive to answer financial questions. As I mentioned before, advisors are here to help you deal with complex financial questions. That's what we help people with. Answer those questions and figure it out. One of the ways we can do that is if you want to hire us to manage the money, we can do that. But there's all kinds of other things that we do besides that, tax revenue, what to invest in, the timing, the allocation strategies, all of that. Those are things that we work with clients to achieve. And then we pick the investment. So that's really what we're talking about now. It's just one piece of the many pieces that we do, but it's an important one. And again, people can do this on their own, but as you're probably realizing, it's fairly complicated. So it does make sense to hire a professional to help you through this process, to navigate this process, to figure out what your allocation should be, work with you to help select the investments so that you're not going to get yourself in trouble. Because let's face it, bad financial decisions can really mess your life up.
Yeah. And it's not really, don't be cheap with your money. Put the money into your money.
That's exactly right. So want to mention again, I don't know if I did it the last one, but again, you can call 804-622-1722 to talk to me, but you can go to our website, click the initial consultation button, and you will get a 20-minute Ask Anything session you can schedule where you can just give me a call, ask anything. We'll have 20 minutes to talk through it and hopefully get your most current pressing financial question answered. And if we can help in other ways, we could talk about a next step from there.
All right. Sounds good. Well, thank you, David. Thank you, Mike. We appreciate you coming on today. And thank you for listening. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Unleash Your Retirement podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rvawealthmanagement.com or give us a call at 804-497-2100. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of RVA Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of RVA Wealth Management. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by RVA Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, RVA Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.